Welcome back, friends. The United States Strategic Petroleum Reserves, or SPRs as they are popularly called, are depleting rather quickly. They have, for the first time since they started getting filled in the early 1980s, the Strategic Petroleum Reserves now stand below 300 million barrels. As you well know, these SPRs or Strategic Petroleum Reserves are stored thousands of feet below the ground. And it is expected that they would come into use in times of national necessity. Now, they have been used during the Iran war to be able to circumvent the oil price increases, and these are also in the Iran war, and these are now beginning to dwindle quite sharply to the extent that the caverns which carry them risk being um, impacted, because there is a minimum level of 70 million barrels below which, if the oil reserves go, that you will find that the caverns get destroyed without repair. This is the situation. Therefore, there is a very high chance that the, the United States administration would now start taking measures to fill these strategic petroleum reserves to higher levels to be able to replenish the drawdown that has taken place over the last few months after the onset of the US Israel Iran war. What would be the economic impact of this decision to replenish the strategic petroleum reserves? The economic impact would be that these reserves would, yes, of course, there would be an attempt to replenish them, but the oil prices would start moving up once again, because naturally the pressure on the supply of oil will increase. More oil would be required to replenish them, and this would add further pressure on oil prices, which are already at very elevated levels. 88 to $90 is much more before what was existing before the Iran US war had commenced. So we have a rather difficult scenario, friends, where the interest rates which President Trump is trying so hard to bring down, um, they remain difficult to do so because inflation remains at very elevated levels. And if oil prices keep going higher the way they are at this point of time, then you will find that, and now, of course, as I said, with the strategic petroleum reserves ready to be replenished once again so that the caverns do not get destroyed because of the low levels of these reserves. So we enter a scenario where more and more oil will be required. Not only this, combined with the fact that so far what the American consumers were getting used to was the old inventories, as the old inventory of electronic goods, of computers, laptops, mobile phones, all these get exhausted, you'll find that there would be a new flock of goods coming in from overseas, as much of the manufacturing takes place in Asia and beyond. All this would start flooding the US markets soon, but these goods would be manufactured at a much higher rate because of higher energy prices. And this would therefore come and impact the prices that you and I would have to pay at the for these various electronic goods, items, even the raw materials, and various other building materials. All this can start coming in at much higher prices. This would once again have the deleterious impact of causing inflation to go much higher. Once inflation goes much higher, you will find that you reach a situation that the interest rates would also remain stubbornly high, and in fact can go up much further as inflation, which looked to be under control in this last July CPI and PPI report, But that was because energy prices at that point had come down a little bit before again now they have started going up, and they will start getting reflected into the future CPI and PPI numbers. All this would have a deleterious effect of causing the imported goods prices to increase, and you and I as American consumers would be importing goods at much higher rates. So the higher prices leading to higher inflation leading to higher interest rates. And let's therefore understand the ultimate impact on the AI stocks. Stock market has been rallying on the back of an AI induced rally. And should this continue any further, you find that the inflation being so stubborn that it is, the interest rates would also remain at elevated levels. At least it will not come down in a jiffy. On the other hand, it will keep going up. If this happens, then the valuations of AI related stocks would come into question, because the valuation of stocks is nothing but a discounted value of the cash flows, and the discount factor, which is the denominator. Once that starts going up, then and the price earnings ratio being constant, you'll find that the numerator or the earnings which are there, the market price of these stocks will also start coming down. If that happens, then that can have an impact on stock valuations of AI stocks, which can lead to a correction in these stocks. And that is not only pertaining to AI stocks, then the stock market as a whole could start losing its flavor, and the entire bull run could come into question. This combined with the fact that we have the midterm elections, the Iran US war seems to be nowhere near to coming at a conclusion. You will find that we just had Scott Besson talk about economic pain of a kind never seen before to be inflicted on Iran, which means that the situation is not at all under control. You have mental issues among people who are aboard USS Abraham Lincoln, and now there's a new ship coming in, USS George Washington. All these indicate that it's a long, drawn-out war which does not seem to be coming to an easy solution, and something to keep in mind. All this we combine with the Anthropic IPO, which is about to come out in the month of October, and this is just 2 months from now, would lead to a fresh supply of over $2.1 trillion in stocks. And all this does not augur very well, because it indicates that along with the SpaceX IPO, now if you combine with Anthropic IPO, lot of liquidity could get squeezed out of the secondary market into the primary market. To be able to subscribe to these IPOs is not a very happy situation. It's not a very gung-ho situation, friends, and could lead to tremendous amount of liquidity being sucked out of the market. Once liquidity gets sucked out, you'll find that it's going to be very difficult to bring in fresh money into the market. So it has been seen in the past that whenever liquidity dries up, it is a harbinger of the times to come. It is harbinger of difficult days ahead for the US markets. And once the US markets start coming down, they will definitely go and bring the rest of the world down with it. To get to know when this can happen, what is the timeline? Is it going to happen tomorrow? I don't think so. But yes, there's still some more steam left to the rally, but the writing is on the wall. Sooner rather than later, this is going to happen. We have definitely worked our analysis as what is the inflection point where this all can happen. And to get to know more, do join our Prime Plus Telegram group, which are specifically addressed for the US markets and their outlook over the next few days, weeks, months. And you can do that by WhatsApping us on 732-732-2720. Happy investing. Take care. Bye-bye.